Now, today we would discuss about the 7 rules that every trader must follow. Now, the difference between the winning trades and the people who are losing the trades is not the strategy. In fact, most of the time I do come across people who tell me that, sir, I'm willing to pay for the strategy. But you need to understand that the strategy alone will not make the money. So it's a discipline. So most traders don't lose because of a bad setup or a weak indicator. They lose because they break the basic trading rules. So you can have the best indicator, the best setup, or even a 90% winning strategy. But without these 7 rules, which I'll be discussing now, follow consistently them, and then the market will eventually make you the money. So welcome back. This is Trade Smart with Mohit. If you're very new to the channel, do subscribe to the channel and click on the notification so that you get updated on every video I post. And now I'm started the series of educational series. In this would be the first general topic which I'm taking. What are the 7 rules which every trader, you might be an intraday trader, you might be a swing trader or a positional trader, but make sure that you follow each of these rules. So don't skip this when you are watching the video. Give yourself some time and follow the video. That's the reason, I mean, I did not want to miss any point, so I have made it in a PPT presentation so that you get the entire gist of it. So the real reason traders lose is the myth that the most traders believe that the losses come from a bad strategy, the wrong indicator, or the poor market timing. They keep searching for the perfect setup or the magical setup, that system that they finally turn things around. Now, the truth is, I will tell you, it is not about the indicator. Most of the time, when we say the price action happens, even in fact, if you use the moving indicator, or in fact, even the volume weighted average price or any indicator which you use, these all are lagging indicators. The price action, probably you are good enough if you just practice the price action. Now the traders lose because they break the basic trading rules. Now you might be saying that, okay, fine, I would not take a trade 30 minutes. Say suppose the opening bell is 9:15 and you say that I would not take a trade until 9:45. This is a rule which you have made for yourself. Now most of the times what happens is that you can't wait till 9:45, and 9:35 itself probably you might take a trade and then you lose the money. This has happened with me several times, and it might happen with you also in the journey of you being a good trader. Now, you need to follow the rules consistently. The market will eventually take your money if you don't follow. The 7 rules in this presentation are what separate consistently profitable traders from those who blow up their accounts. So protect your capital first. Now, how many times we need to tell that? Say suppose if your capital is protected or your risk management is right, the second trade you will have the money to bet on. If you don't have it, then probably you will not have the money to bet on as well. So your first responsibility as a trader is not to make money, but it is to protect your capital. If you lose your capital, you lose the opportunity to trade tomorrow. So many traders obsess over profits while neglecting the foundation that makes trading possible. Now their account balance. Now without capital, there are no more trades. I tell you 100 times about this one. Without capital, there are no more trades. Even a no trading day is a good decision. So no more setups and not more opportunities. So capital preservation comes before wealth creation. Survive first, prosper second. Every trade you take should prioritize not losing over making money. The second is always trade with a defined risk. Now, usually when we sit for trade, we usually keep about 1 to 2 percentage. Maximum, I would say, is keep 3 percentage of the total capital as your stop loss for that day. When you define the risk, you are in control of the risk. The only thing which is under our control is the risk, not the profits. Not the profit. Profit is unless and until you don't realize it, you don't make any profits. So understand this one. So when I will enter, define your entry point before the trade. You have a book or a diary. So define that entry point. Okay, fine. What should be my entry? You put your time, or if you're a time trader, or you put the price if you are a price trader. So put the time or the price of entry, and then where will I exit? Now you must know where will I exit. Now there are two things when it comes to exiting. Either it can hit your stop loss or it can hit your target. So you define this well before in advance. And how much am I willing to lose? I've always told you keep 1 to 3 percentage, the maximum, nothing more than this. Never let emotions make decisions. This is the rule number 3. Now, at times what happens is that we have taken one trade, we have made a negative. Probably we taken the second trade to make this one good. Again, we end up making more losses. This accumulates and it becomes so much that when you are in that you are in an emotional state of mind wherein you will not be able to take any rational decisions. So fear, greed, revenge trading, and fear of missing out destroy more accounts than bad strategies. When emotions drive your decisions, you abandon your plan. So move stop loss, never move the stop loss. I've seen many times people move the stop loss. Okay, fine, 60 points you had get the stop loss, you make it 120 points because you are very sure, according to you, you are very sure that the market move will move up or down, whatever positions you have taken, but seldom it happens. And take trades, you should not. So you, if it is not in your rule book, don't take a trade. Trade with logic, not emotion. Trade fear, closing winning trades too early out of anxiety. Greed, holding losers too long, hoping for a reversal. This is again a bad sign. Revenge trading. Now jumping back in immediately after a loss. Whenever you have made a loss, at least I would suggest you not to trade that day. Just close the laptop and go away. Or else, probably if you want to take a trade, at least leave about 30 minutes gap between the two trades so that probably you can regroup yourself and come and sit at the trading desk. Fear of missing out, it's okay, let the markets go. You have missed the entry, it's okay, but you don't have to chase the market. Say suppose the markets have already rallied and you thought that okay fine, this might have been my entry point, don't enter here. Why? What happens is that although your target is this, say imagine the hard target is 100, it is now at around 85, don't enter here 85. Your probably entry point might be 65. Unless and until it comes to 65, don't take, because the market has a tendency of retracting. Probably it comes to 70. What happens? Hits your stop loss and then market goes to 100. So this can happen. So chasing entries without valid setup is a strict no. Follow your trading plan. Now, if your setup isn't present, don't trade. I always tell that. Most of the times you have seen my profit and loss statements. If I don't have a setup, I don't trade. Sometimes the best trade is no trade at all. A trading plan defines exactly when you enter, when you exit, and how much you risk. Deviating from it, even once, opens the door to emotional decisions and inconsistent results. Now, discipline creates consistency. Consistency creates profitability. So discipline, you need to be disciplined to be a consistently execute your trades, whether it is profit or loss, that's fine, and then it makes you, or eventually it makes you a profitable trader. The market will always be there tomorrow, understand this, but only if you have the capital. If you don't have the capital, if you are running the risk of ruin, then probably you will not be able to take the trade the next day. What is the golden rule? Patience is not inactivity. It is warning, it is waiting for your edge. So no setup, no trade every time. Understand this. This is rule number 4. Rule number 5 is accept small losses. Now, how many times we have read that whenever the market is going against your direction, cut your loss short. Cut your loss short and let the profits run. So no traders win every day. In fact, even if you see, probably my ratio might also be around 60 to 70 percentage of the trades I make money, 30 percentage, 20 to 30 percentage probably we lose money. So successful traders keep losses small and cut them quickly. The biggest mistake traders make is holding on to losing positions, hoping that the market will turn around. I have explained this. Hope is not a trading strategy. I always tell this when I take the classes also. Don't trade on hope. See what is happening in the indicator, what the price is telling you, and just trade on the reality. Right? Hope trading, you will lose your money. So it's the fastest way to turn a small loss into a catastrophic one. Amateurs hold losers, hoping for a reversal. Let small losses become big ones. Probably, for example, if I say, if an intraday trader, my most of the videos would be focusing on intraday trading. Say, suppose if you're trading in Nifty and if you have a stop loss of 25 points, it hits 25 points, but you somehow fail. Probably one of your indicator is telling that, okay, fine, you need to wait. You wait till 40 points, then again it goes to 60 points, then you don't know what to do, you just exit the position again and go short. Imagine you take a contract trade in this direction, again the market starts going up. So that's when you lose more money. Don't hold on to, you have to cut here. 25 points is your stop loss, cut and close the system. That's all for the day. Accept. Professionals, what they do is that they accept the loss, respect the stop loss, and move on to the next opportunity. Every day you get an opportunity. Probably you might not be have been able to identify the market today, but tomorrow, what if you are able to identify the market? You would more be you would not even compensate for the loss, but you might make more profits on top of that. So rule number 6 is trade what you see. I always tell you, don't do hope trading. Trade what you see, not what you think. Say suppose there is a news. Imagine that there is a negative news in the market that the US and Iran have gone to war again and the markets have opened gap down. Imagine that the market, this is the previous day's close, the market is open gap down here. But what is it telling? There is a strength right from the beginning. Now, just because you have heard the news, it doesn't mean that our markets have to fall again. They've opened gap down. What does the gap down mean? If probably if the markets were open, this is the place where they would have been by now. So the market has already discounted the war news. Probably now, probably it might go up, right? Probably it might go up. You never know. So check the indicators or oscillate or whatever you are seeing and see if it is showing strength. Probably you are better off buying it. If you are in two minds of it, then please don't trade. But don't trade based on your emotions. Don't think that, okay, fine, the war is continuing, the markets will fall. They might or might not. Or the company has posted good results, the company is supposed to rally. No, because there is something called as the buy on rumors and sell on news. So there are intelligent people who would have started accumulation phase of one particular stock probably 3 months before itself, expecting that the it might give good results. So probably here itself they might started accumulating it. And now once the results are out, they might just book the profit. And now what happens is that once they book the profit, the stock or the particular index comes down. You might be wondering why is that the results are good, but why this particular stock is coming down? Because there's a profit booking. What you have missed out is the accumulation phase. And now you're sitting on the distribution phase, and then you're wondering why the markets are coming down. So predicting where price should go based on opinion, news, or gut feeling, never do this. This leads to forcing trades that aren't there and ignoring what the chart is actually telling you. The truth is always the price. Every candle tells you a story. Your job is to read the candles and not write it. So suppose if you are completely new, you have access to so many numerous videos on YouTube itself how to read a candlestick chart. Although I'll be taking session wise, that also this all free courses will be there in the playlist. In the playlist, you can go under the section of technical analysis for beginners. You'll be able to find the course content completely. So when you trade, what you see, you align yourself with the market's actual direction instead of your assumptions. You never trade on assumptions or hope. What you see is reacting to price action as it unfolds. Trade what the chart is showing you, not what you hope or believe will happen. Don't force your belief onto the market. It might not happen. The market is always right. Your job is to read it and not predict the market movements. Review every trade. Now, this is the last rule which I stress. Maintain a trading journal. Now, how do we maintain a trading journal? How do we enter and exit? What are the entries? That's again detailedly explained in the courses in the coming sessions. But this is just if you're already trading. The seventh most important thing is maintain a trading journal, because if I say there are three best books what you can read to become a successful trader, one I would say probably any book, the Benjamin Graham, The Value Investing by Benjamin Graham, and then second probably it can be any of the Peter Lynch books. You can take it, or any candlestick book by Steve Neeson. And the third, but the most important, would be your trading journal itself. Your trading journal is a repository of all the information which you have carefully jotted down day in and day out. Your mistakes, your entry, your exit, everything you would have noted down. That is a lesson for you, not to repeat these mistakes again in the future. Now, how do you do? Just writing the journal is not enough. Every week, at least allocate 2 hours to revising this trading journal religiously. That's when you build. For example, I sit every night, the day before actually, and revise whatever I have written in the trading journal. It will be concise, no matter how many years journals you have. But the simple rules and strategies remain only probably in 10 to 20 pages. So read that every day before going to bed, or probably you do it the first thing once you get up in the morning, because that's your preparation which you need to do religiously before you sit for trading. So Every trade, win or loss, is a lesson. Reviewing your trades consistently is how to identify patterns in your behavior. Catch recurring mistakes. Now, trading is more of a psychological act. In fact, forget about technical analysis, everything, it's a mind game. If you're not strong enough to take a trade when you see the signal, or probably you are entering late because because probably 2 days before you would have made losses, and then the third day you enter a trade, probably you wait for some time to confirm the trade and enter, and then it again moves against your direction. Although your entry should have been at the earliest point, you miss on the trade, or probably it hits your stop loss. Don't do that. How to overcome this? You have a trading journal and see where were the mistakes which were done previously and try not to repeat them again. Reinforce good habits. Without a journal, you repeat the same errors without even realizing it. So this has happened with me many times, so I'm telling you not to do it. Why did I enter? Give a reason, or at least set a plan or something, just write it down. Did emotions affect my decision? Did you cut short your positions too early? Did you take only little which money which was left on the table, or were you able to hold to make more profits that day? Or did you lose the money because you did not put a stop loss? Or was your stop loss there and did you start shifting your stop loss because of the fear of losing money? Write everything. Did I follow my rules? This is the most important thing. Now, how do you reward yourself for following the rules? I say reward yourself probably 2 points for every rule you have written in your book. Probably there are 10 set of rules. At the end of the day, you must make 20 points. No matter whether, forget about the profit or loss what you're making. Follow this process. Okay, fine. Now, how do I do it? Set up the rules. I will tell you one simple example. Have a trading journal. You say that the rules is that I will enter not before 9:45. Okay. Second, I would not take more than 2 trades per day. Third, I will strictly adhere to my stop loss. Like this, have some about 5 to 6 or how many number of rules you want to make it. You make it because this is a individual specific. This not need not be general. Okay. Now, say suppose 9:45, I stuck to this rule. Give yourself 2 points. 2 trades per day. Give yourself 2 points. Stop loss hits your stop loss. You exited that day. You did not overtrade, 2 points. End of the day, are you able to make 20 of 20 or 10 of 10, whatever you're doing, irrespective whether you have made the money or not. This rewarding yourself will help you progress and realize your mistakes, and it will help you not to commit the mistakes again and again. What can I improve tomorrow? Now turn every trade into a learning opportunity. Either you make the money or you lose the money. The losing trade always gives you an opportunity to learn. So write it down. The losing trades is the fees what you have paid to the market to learn something new. So respect that you've already paid the money and then write it down in the journal so that it can be useful for you in your own next trades. So these are the 7 rules. So let me summarize this again for you. Trading success is built on habits. One is protect your capital. Second is define your risk. Ideally, maintain the risk to 1 to 3%. Control emotions. No FOMO trading, no revenge trading, no trading because of fear or greed. Follow your plan. Don't have a plan, don't trade. That itself is a no trade day itself is a good day. Accept losses, cut down your losses to a minimum as possible. But that doesn't mean that even a 5 point movement would unsettle you and you exit with a loss. No, define a loss, define a risk man, have a proper risk management tool. How you are quantifying that particular risk for that particular day or for particular stock or index. Say suppose Nifty 25 points is your loss, so respect that. Don't have to keep like 10 points or 15 points. It will every time it will hit, right? Trade what you see. Don't trade your hope. This is what, don't put your emotions and don't trade what you are seeing in the news. That might not be the case. See the price and react to the price. Don't try to predict the market. And review every trade. How do you review the trade? Write it in a journal and review the trade at the end of the day or probably at the end of a week or once in a month. That would help you in that's the best book which you are ever going to read in your entire life as a journey from being a day trader. That's it, guys. And if you found this useful, do give a thumbs up, like button, comment on what you think. And I have already started the session, so you can go and check the free foundation courses as well. You have a great weekend ahead. Bye bye.